Welcome to the Commercial Real Estate Podcast, powered by First National. I am Adam Powadiuk, sitting here with Aaron Cameron at our first interview, first day of the doubleheader at the Goliath Toronto Real Estate Forum. Biggest event of the year. There's people everywhere. Of course, this is part of our speaker video series here in conjunction with Canadian Real Estate Forums, sponsored by Glass Lake. We do thank them for that. So our first guest, we wanted to try and keep up, because Adrian, you can feel his mind always running, and so our first interview is always better than our last, after a 2-day marathon. We got you intentionally on first here, but returning guest, I believe a fourth appearance, so getting near the top of the charts in terms of repeats. We thank you for all the time you spent with us, but welcome back, Adrian.
I feel like I'm old news now, right? You gotta get some other talent.
Needs no introduction, of course. And just backing up a little bit, it is true. By the fourth or fifth episode we do in a day, I'm not paying attention. No offense to those guests that have been on, but I wasn't listening.
It's tough to talk about cap rates for 5 hours straight.
All right. So, Adrian, maybe just really quickly, it's been a year, so maybe just give us a quick update with the projects and what's going on in the last year, and then we'll jump forward.
Yeah, I would say the market's definitely had its headwinds over the last year. In terms of relative performance, we're really happy how we're performing, but we're definitely down on net effective rents. If I look at Toronto alone, we're down 21%, right? So it's been a bit of a dogfight with other purpose-built rental operators, but also condo investors that are flooding the market right now with condo inventory that's hitting the chattel rental inventory. And so that's been fun to manage and deal with. Taking a step back, strategy-wise, we have announced internally, not formally in the market, but we're getting into the retirement space with a programmatic JV partnership we have with a public company. So that'll be 2 development deals in Toronto and the GTA, 2 deals hopefully in Vancouver and Greater Vancouver and Surrey, BC, which we're really excited about. That's really our first entry point into the Vancouver market. We have also taken over the property management of phase 1 of Sanok, which is an iconic master plan in Kitsilano and in Vancouver. Beautiful architecture. It's the exact type of project we always want to get into in a new market like Vancouver. So very fortunate to be working alongside Enchikai and OP Trust and the rest of the team there. I would say student housing has been a focus of ours right now. We are very, very bullish on the student housing market. What we don't want to do is partner with the institutions, right? We think it's de facto rent control. It's not the right cultural fit for us, but we want to be buying and developing on private land, either directly adjacent to the universities or in the main entertainment nodes where university kids want to hang out. So we bought 3 deals, 1 in Guelph, 1 in Kingston, 1 in London. We're hoping to start construction 2 of those 3 deals the second half of next year. That's a focus of ours. And we're working on something in Hamilton near the McMaster Gates that we're close to putting under contract. We want to do 1 or 2 more in Kingston, Waterloo, and then execute that as our next stage of growth around student housing. So it's student housing and retirement is our near-term focus. We see a lot more interest in the value add space, even kind of down the risk spectrum in core plus, but mostly in value add. We're seeing a lot of foreign interest in the value add space right now. We think it's the right risk-adjusted, compelling return. Very bullish on it. But the biggest contrarian call for us, which I know you're going to push me on, is develop the core Class A in Toronto. We're very, very bullish on that right now. The market is not. And when the market is here, we want to be on the opposite side of that. And I think the medium to long-term fundamentals in that space are very, very attractive.
A year ago when we were talking, the answer probably would have been a ton of units, but all in the kind of core assets you're talking about, all GTA, looking at other markets. So this is quite the expansion of the program over the course of 12 months, multiple asset classes. You're now officially into other provinces.
We've been in Montreal for about 2.5 years.
True. Sorry. Yes. Yeah. So I didn't miss that. Yeah, I've been up there with your core fund or value add fund out there. Is that the full growth pattern? Is there a further afield that you would go? Is there other provinces you're looking at? Is there other asset classes within the space that would make sense? I mean, not that I'm saying take more on, because that's a lot. But
Yeah, look, we want to get those markets right. We feel like we have really great leadership and boots on the ground in Montreal, so it's doubling down on building scale and critical mass in that market. We want to take our time and be really deliberate in Vancouver and execute on what's in front of us and do that really well. I'd say the next 2 to 3 years, we'd love to be in Alberta, so Calgary and or Edmonton. That would be our next focus. And then maybe the Maritimes beyond that. Aspirationally, in 7, 8, 9 years, I'd love to be over in Europe. I'd love London. I got a lot of capital relationships there, a lot of relationships in the real estate space. I think our product lends itself really well to a sophisticated market like London. So that's more aspirational, more romanticizing.
Well, the name Fitzrovia came from London, right?
That's exactly it. Yeah, my daughter was born there and we lived there. So, yeah.
There's a lot of symbolism in returning back.
Yeah, but our focus right now is just we got a lot of opportunity with what's in front of us right now, and it's continuing to build scale and operational expertise and some new strategies like student and like seniors.
How are the conversations with your investment partners? I mean, you guys have done a great job of raising capital for the different funds, for your investments. I mean, as you alluded to, the market in general is in a very sort of hesitant, sort of risk off. There's a lot of uncertainty. I mean, we don't need to get into all this with geopolitical risks and everything that's going on. There's inflationary pressures, everywhere you turn. But yet you seem to be able to have supportive investment to allow you just to keep investing, keep going when others are not. How do you get through to them to let you proceed, to give you that money?
One is really focusing on what you can control. So what is your relative performance relative to, other purposeful rental operators, right? How are you doing with leasing velocity? How are you doing with relative rental rate, right? Rent per square foot, we're 8 to 11% higher than other purposeful rental operators. Very proud of those results. You would think in a softer market that you'd see compression on that spread, and we just have not seen that play out in our portfolio. If you exclude any assets that are under active lease up right now, so we've delivered within the last 12 to 18 months, especially our large master plans, we're about 96% occupied with that rental tone. So very
sticky rents.
Yeah, for stickier. We're still seeing, net effective rents down like the rest of the market, but we're keeping our spread. Right. So it's still a bit of a dogfight on making sure we could keep that spread. But so far, our story seems to be resonating with our end consumers, with our residents. And we think in this market, that's really telling. A lot of people would question, doing all the lifestyle management and the attention to detail and, the higher finishes and better amenity package, and it'd be under pressure in terms of that spread. And we just have not seen that play out in our portfolio. And I would also just keep an open line of communication, right? Like we are very entrepreneurial. I think when there's noise, there's opportunity. And so we are net acquisitive in this market. We've done 7 deals in the last 12 months. We want to do the same going into 2026. We'd actually like to do more. I think in 3 years, we're going to look back and say, I wish I bought 2-3x, the transaction volume I ultimately did or we ultimately did. Same thing I saw play out in Europe, 2008, 9, 10. Those were really amazing years, a great window of opportunity to go and buy land, buy IPP, take contrarian calls in the market, and we view this market no different.
Do you view all the asset classes that you're in as contrarian right now, or just the downtown high-end product? Like a student contrarian view, is seniors a contrarian view right now, other markets?
Yeah, so it depends on what buckets of capital you're talking about. Seniors is not a contrarian view. If you look at the public markets, they're actually trading very well. Everyone's trading on a premium to NAV. But if you look at private capital, institutional capital, they've obviously shot away from the sector post-COVID. And so is that contrarian? I would argue it's probably not contrarian, right? The macro fundamentals are really strong. Whether people want exposure to it is a different story. So maybe tucking that aside, student, there is a lot of smart US private equity capital that's looking for that exposure. Risk adjusted, I think it's very attractive. The more contrarian call is around IPP and developed decor, especially in the urban markets like Toronto. There's so much negative noise right now around the softness in the market. But this is precisely the time where you want to buy the rent proxy. What I mean by the rent proxy is in the next two to 3 years, I have not seen supply being sub 10,000 units in the Toronto market, which is what we're going to see play out. And that's going to carry for at least 3 years, if not arguably 4 years. So you're essentially going to be able to put a shovel in the ground as costs are decelerating, right? 15% lower hard costs today than where we were in 2022, if not a little greater. That's continuing to trend in the right direction. And you're essentially delivering in a market that's starved of new supply for 4 years. It's a really compelling window to invest, right? So long as you can make a contrarian call on where you think rent growth is going to go to, versus, looking at rent growth in a really tight box, 2.5%-3% rent CAGRs, I think that's way too conservative. If you layer in how we saw rents behave the last 15 to 20 years, and you look at the supply demand story, like what we're going to see play out in the next 3 to 5 years has never been the case over the last 20. So I actually think we're going to be in a high single digit, low double digit year-over-year rent growth environment. Hard to underwrite that, but if you look at the spectrum of probabilities, I think it's a really high probability. And when that happens, we really want to lay our bets.
And this is strictly the whiplash of massive deliveries for the next 18 months and then going to virtually zero shortly after.
Yeah, if you look at the Toronto stats, we're 30,000 units delivering in the next 12 months. That compares to the long-term average of 15 to 17,000 units. That drops in year 2 to 17,000 units. Year 3 drops to 7,500 units. Year 4 is 3,500 units. There's nothing that's going to structurally change those numbers. If you're fast, it's going to be 4 years to deliver, right? So that's going to creep into year 5 as well. So we just think that's an incredible opportunity around rent growth. That's not good for the end consumer, by the way, right? These knee-jerk reactions around policy is not good, right? But the reality is that is coming through the system right now. That will play out, and we think you're going to see rents skyrocket in that kind of back half of year 5.
One of the variables that obviously impacts rents is just income growth, and that's been contributing to some of the flattening of the rent that we've seen recently. How do you input rent growth or income growth into your calculus when you're having these conversations?
Yeah, look, net effective rents are down 21%. If you go down to 2022, when we looked at shelter cost income ratios, and it depends on what assumptions you put in, whether it's a couple living in a 1-bed or a young family living in a 2-bed or a roommate concept living in a 3-bed, it's anywhere between 20 and 25% of the population could afford to live in one of our buildings, $5 a foot rent, right? That's, again, a 30% shelter cost income ratio, which CMHC would say that's an affordable benchmark to look at. Well, rents have come down 21%. Right. So if you assume no real wage growth or even inflationary wage growth over that point in time, you're now well into the 30s. Right. So we actually think there's a long runway ahead of us. I also think affordability generally takes a backseat to necessity. Necessity being we are going to have a growing population. There's a lot of noise around what's happening with your immigration story today. But what we do know is the federal government's going to come out and crank up their immigration targets at 380 to 420. Which is 24 to 34% higher than where the immigration was, which we led the G7 pre-COVID, right? We also are seeing home ownership rates dropping. You guys are in the for sale market. Home ownership rates 7 years ago were 71.5%. Today it's at 69%. We think that's going to trend closer to 65%. So you have this incredible ramp up of demand that we're expecting and essentially no new supply. And so we think that's going to be the perfect storm on rent growth. So I actually don't think it's a bold call on, a contrarian call in the market. I just think it's so crystal clear of how it's going to play.
Yeah, no, and the supply and demand curves, it feels like a simple economic, interpretation. How do you're mentioning net effective rents? Maybe just discuss sort of the incentive war that's going on right now and how that's sort of how you view that.
Well, and your newest, coolest incentive for the
we're trying not to have a race to the bottom on incentives, right? So
it feels like it is, though. Right? It feels like I mentioned it a war. It feels that way. Like there's a competition out there to keep your face rates up, but attract the tenant.
Trying to change the story very much so. So if you look at face rates, we're probably down 11 to 12%. I say net effective, layer in, whether it's cash incentives or rent free, you're down 21. So what we're trying to do is make a big call on loyalty and innovation. So we want our product to feel and look fundamentally different than the rest of the market. So we don't compete solely on price. It's all about value proposition. And then we have unique partnerships where we leverage our size and scale. We have a partnership with Chexi and Aeroplan. So all you have to do is pay your rent. I feel like I'm running a commercial right now.
No, but the Aeroplan one is cool. It's like 150,000.
I love Aeroplan points.
Everyone does. We all do. And so we made a big call on loyalty. And our view is all you do is pay your rent. For every dollar, you get one Aeroplan point. So for a 1-bed, you could get a free trip to Europe. For a 2-bed, you could get a business class trip to Europe. We think that's really compelling, and it seems to be really resonating with our residents.
Very cool.
On the incentive front, do you see that tapering off at some point, or do you have another year ahead of us where that's going to be the standard for kind of the best-in-class buildings?
It will definitely be in place for a year to year and a half, and then they will pull out really quickly. It's definitely a renter's market right now, but we will get into a normalized, then a very tight market, and I don't think any incentives will play out in that phase of your rebound. I just don't. If you revert back to where we were in 2021 and 2022, there's almost no incentives in place. Yeah. We're going to revert back to that market very quickly.
That'll be the first sign, inflection point, I'm sure, in rents. Sure. That'll be the first.
But it probably goes in tandem, a lot of correlation with just the way that the condo unit sort of tapers off, right? The condo availability kind of comes down.
Yep.
As soon as that comes down, then all of a sudden the market turns for you, right?
Yep.
You're outspoken, a lot of advocacy work on behalf of the industry. Because your position, you get you get to get in rooms of people that most can't. So when you're giving messaging to various levels of government and groups that can influence our entire industry, what do you have as your top 2 items right now? The top 2 things that you're advocating for the market?
Yeah, I'd say it's really one, right? So it's a pretty simple industry, and we try to overcomplicate things and make us sound smarter than it really is really required. It's speed of execution. I do think that's more of a secondary issue right now. When I say speed of execution, our ability to pull permits and zone sites. The industry is sitting on millions and millions and millions of square feet of fully zoned sites ready to go. The economic model, if you're not making a bold contrarian call, I don't think it's actually that bold, but a contrarian call on rent growth is broken, arguably, right? And so how do you actually get institutional capital, who generally will underwrite within a really tight box on rent growth, off the sidelines and investing capital into more rental housing? Well, it's eliminating a big chunk of your total development costs, which relate to government fees, levies, development charges. And so we would say in the next 1.5 years or 2 years, do a full waiver on development charges. Rip out property tax for 20 years, right? Every time you've done that in the US, you actually saw, especially in the Sun Belt, when they wanted to get more supply going, you saw huge rebounds of new supply, developers kind of doubling down. It's actually the most effective tool. If you look at $1 saved on NOI or given up, it's a 30 times multiplier, simple cap rates on its impact on value. So we would say start there. Do it for a year and a half, get as much new supply into the market. And then as the condo supply and the rental supply starts tapering off, right, you're going to see rents rebound, pull it and let market forces take over. But every day that goes by right now where we're not creating new supply is just going to compound the issue. And the market seems like it's playing in the government's favor right now, but that cliff's right there and it's not moving, right? It's coming quicker. And so we have that dialogue quite a bit. The problem is it's not popular when you see the noise and rents that are dropping right now, right? And so are you really going to see a politician, make a call like that when the rest of the market and the headlines are, this is a renter's market and the system's not broken? And so that's the issue right now is, are you going to get bold leadership to really ultimately make those calls? They do a great job engaging. We've been in lots of workshops, just given our size and scale, we got lots of folks reaching out, all 3 levels of government. But at the end of the day, when push comes to shove, we're not seeing that bold policy.
It's so myopic, right? They're like, look, it's fixed. It's fine now. It's like, guys, real estate is like a 20-year cycle. Like you need to be thinking in 20-year clips. Like what's happening today is irrelevant. But I was at a lunch with the developer out west. He was describing a story of running into the premier of BC, who was surprised that the developer was upset because he was like, what are you talking about? Our policies are doing great. Everything we said is working. Like we're doing amazing. And that's just, and it's such a political response to, the market, right?
Yeah. Or, we got, just build. I'm like, we'd love to build. We're builders. We're developers. Trust me, we'd love to get to work.
This is like kind of a tongue-in-cheek question, but I think I find it interesting. So, I mean, you are outspoken. You're doing a lot of advocacy on behalf of our community, and so thank you for that. And yet, I mean, you're aligning yourself with some of the initiatives that CMHC's put out there to, bring in more affordability, more supply. They want the more supply, but theirs is based on, 2019 affordability, meaning they want rents to come down to that level. And I always kind of I giggle at the idea that you're out there advocating so that we can bring rents down, right? Which is obviously not what's going to happen. But do you ever, how do you reconcile that at times?
Yeah, look, I think we got to let normal market forces take over, right? Just create as much supply in as possible. That's gonna beat our demand, our rental tone. Sorry, and so that's where I would start. We do need a chunk of the market that is being delivered that is truly affordable rents, right? So call it, middle of the road income levels, and even some social housing. We should do that with unique debt tools like the CMHC ACLP debt program. That's very smart financing where both sides are winning, right? It's not really a government handout. It's a financing tool. They're lending money. It's getting return. It's a very attractive structure, 90% leverage, Government Canada bond rates, right? Where you could actually generate a really creative yield on cost and IR on those deals. The flip side, when you're passing the full obligation of those affordable units, which is what City of Toronto is trying to do, onto the private developer, it does not work. It makes the whole market unaffordable, right? Because it restricts supply, which is going to obviously increase rents over time. Back to it not.
It's the rent control. It's the whole rent control quandrum, right?
Yeah, I think you're bang on. Like the government has done a great job engaging the private sector. We talk about the need for bold policy, right, which is not happening right now. The one thing I would say is these quickly moving of goalposts is not helpful, right? We need a landscape that is stable, right? I love tax reform, right? Domestic capital is only going to take us so far. We got to get foreign capital investing in this country. And I just came back from the Middle East last week, and we're talking to those investors, the tax drag is significant, right? It's also perceived for a long time as an insider's market, right? We have to find ways to open up the gates to get that capital here. This is a $2 trillion issue, right? This is not a, $50 billion, build out that's going to solve it. Canada builds at $12 billion is going to be a drop in the bucket. That's 20,000 homes spread across the country over the next 5 years, right? Like we need that in Toronto alone in 2 years, right? So that's not going to solve the issue. We got to use Canada builds and that balance sheet to leverage with the private sector to change the economic model to get both domestic and foreign capital investing in the sector. If I had to put it in a nutshell, that's what it would be, right? And so we need to think more broadly around some of that policy that's worked really well internationally, right? Like we don't have to recreate the wheel. Let's borrow some of those really great frameworks around tax and how do we get foreign capital coming to the country and apply it. And keep it in place. Don't keep pulling it or trying to adjust it. We don't need government intervention beyond that. Put the framework in place and then let the private sector get to work.
Yeah, I love the idea. Like government can't build these units. Like you mentioned, $12 billion is a huge commitment, and we're happy for it, but it's not very much. If you think about
you think it's big, it's not.
You think about the 1.5 million units that CMHC suggests we need, like that's $1 trillion of development costs. Like, and we're not going to be able to do that through the domestic private sector and public money. Like we need foreign capital to build those units.
Yeah,
right?
like if you look at what we have in Toronto right now, we have 4 multi-tower master plans between $800 million and $1 billion to build out, right? 4 each, right?
Yeah.
So that's not cumulative. Right. So, and then you put that in place in terms of a national Canada Builds program. That's not going to solve the issue.
Yeah.
We got to think more broadly than that.
Yeah. Adrian, let's finish there. That was a great conversation. We appreciate you taking the time to come on. It's a busy day. It's busy for everybody. Thank you to Glass Lake Funding for sponsoring the episode. Of course, thanks to Real Estate Forums for having us here at the Toronto Real Estate Forum. Thanks again, Adrian.
Perfect. Thanks for having me.